All right. Let everybody come on in. Happy Thursday or Thursday. Happy Tuesday. See, now we have some theme music this Tuesday. We're improving. Let me make sure everybody has access in the chat and everything. So 1 second. Now you should also maybe even have video as well. So come on in. We'll change the view here a little bit. You can chime in the chat. And is it allowing you to have video? I believe we allowed that this week. So maybe it's going to allow you to have the gallery. Possible. Yeah, it should be showing you a gallery perhaps right now. Let us know. There's a little thumbs up in the chat. How's everybody doing tonight? Awesome. Come on in. Can you guys hear me okay? Yes or no? Make sure the audio is okay. Looks like it's going okay. We'll get started in just a minute. Hello, hello, hello. Beautiful. Can everybody hear me okay on the audio? Thumbs up. Beautiful. Okay, we're going to wait 2 more minutes till 6:05 or 9:05, depending on what coast you're on, and then we'll get started. Yeah. Beautiful. Okay, hey, we have a treat for you tonight, for everybody in here. I'm going to be actually literally showing you how I would search for a property, starting with a market, and then how I would go into that market when this property doesn't make sense financially, but it's a market I'm interested in. How would I then find better deals or maybe pre-market deals, off-market deals, stuff? Those are the ones that are going to make sense. But I'm literally going to walk you through step by step of exactly how I would do it. And we're going to do it in Cincinnati, Ohio tonight. But I'm going to walk you through exactly how I would do it if I were going into any market, just like we did for the very, very first time many years ago back in Kansas City, Missouri, going out of state, coming from California. How we actually found properties in that market, started with the on-market, got to the off-market or pre-market stuff, and then started to find the deals that made sense. And I'm literally going to walk you through that this evening. So chiming in for where's everybody out from around the country right now? Just put a little thumbs up. Where are you from? East Coast, West Coast, your city, state? I'd love to hear it. California, San Dimas, love it. Dallas, Texas. Good old Dallas. Dallas and Fort Worth. New Jersey. Love it. Orlando, Florida. Beautiful. Folks are from all over the place. I love it tonight. Awesome. Perfect. I'm going to put up a little question for you. Let me launch this one for you. What interests you most about multifamily? Is it the passive income side? Is it building retirement, generational wealth? Is it scaling big and becoming a multimillionaire in the multifamily space? Or, hey, I want to get out of single family investing and into the bigger stuff. Okay. Mix of all the above. As everybody's chiming in. Yeah, a little bit of everything. And you can choose multiples. So, although we should have made it one. Because then you're going to get mixed. But this is good. I love it. Yeah, so good mix of all. Good mix of all. Awesome. So I'm going to share those results with you so you guys can see those. Hold on one second. Someone's trying to get on in. Try this. There we go. Got multiple people trying to come into the webinar tonight. I was just texting one that was trying to come in right now. Okay, so let's get into it. First and foremost, let's break it down. Has anybody here bought an apartment yet? Or are you kind of, is everybody, actually, I'll put that up real quick because this will be really, really helpful. I'm going to launch this real quick. Where are you at? You're a pure novice. You're learning some things, have a few rentals, currently in multifamily and doing pretty well. Want to get a good idea to see kind of where, how deep I need to go, how analytical I can be tonight versus not, and make sure I'm nailing it home and giving you common sense, layman's terms, directions on what we're doing tonight. Okay. Awesome. So some single family rentals mixed in with a few rentals, 2 to 4 units, done a few deals, flips, wholesales, and then some novice. Love it. Perfect. Yes, I'll share that with you real quick. So that's what we're here tonight, is to kind of show you, hey, how can you buy multifamily? When I say multifamily, I mean 5-unit properties or more. 5-unit properties or more is classified as multifamily, right? Anything less than that is residential property. So 4 units, 3 units, 2 units, 1 single family, all residential. 5 units or more is multifamily, okay? Okay. So kind of breaking this down for you. You know, how do you buy an apartment building in the next 90 days if you wanted to, and do it with really as little as $18,000, $15,000, $20,000, $25,000, $30,000 out of pocket? Okay, how can you do that? Well, you have to understand the beauty of this thing called OPM, other people's money, not being afraid of it, and understanding the science of how you can leverage it for yourself to grow your money in conjunction with others. Okay, your money in conjunction with others. And that is how you're able to do this. But first and foremost, you have to find the properties. And then you have to know how to analyze them. And then you have to know how to finance them, okay? You have to know how to finance them. And then close and manage. Those are really the 5 pillars that we teach consistently, and we do every day when we're buying deals around the country. You're going to go through the same method, but there's a lot of nuance to this. There's no doubt that there's an enormous amount of nuance in between each of these main 5 pillars. Now, tonight, we're going to really be getting into how you find the deal, analyze the deal, and I'm going to do this in real time, case study, hands-on. You're going to literally watch me walk through it, so that way you can get a feel for it. And then it's a matter of, hey, how do we finance, close, and manage, right? And we can get into the Q&A on that as well, okay? So just to kind of break this down, when I'm looking for deals, okay, and I know it's kind of scrumbled, my handwriting's horrible, by the way. So IRR, this means internal rate of return. So when you hear that term ever, these are little terms you're going to hear. And we have glossary of terms, things you can download and stuff like that. But you would learn all this when you're learning this space. IRR is internal rate of return. That is the speed at which your money is returned to you when you're buying something, okay, when you're investing in a property. You're going to want to look for something that's between a 14% and a 20% annual rate, which is IRR, annual rate of return, okay? 14 to 20% on your money. Think about that for a minute. If you go to the stock market, it's what? 8.2% average annual return. That's projected. You could look over 100 years of the stock market. It's 8.2% per year. You'll have some years that are high, some years that are low, some years that are high, 8.2%. So if we're coming in here and saying, hey, we're going to be looking for things that are going to projected return to us between 14 to 20% a year on our money, it's a pretty decent return. It's a risk-adjusted return for a medium risk in real estate against a cash flowing asset that can return that to us. That's pretty healthy. Pretty healthy. Cash on cash, COC, cash on cash return, 6 to 10% a year. What that means is if I put $100 in, I'm getting 6 to 10% on that per year back. $100 goes in, $6 to $10 comes out. $100 goes in, $6 to $10 comes out. 6 to 10% cash on cash, okay? And EM stands for equity multiple. What that means is if I put $100,000 in and I get 1.8 to 2 out, right? Let's say it was 2. If I put $100,000 in, I'm getting $200,000 out. $100,000 in, $200,000 out. That's a 2 multiple, right? Those are really the 3 metrics that I focus on from a high level first before I would ever dive deeper on any property. IRR, cash on cash, and equity multiple. And you're going to see this right now as I dive into an actual property and we walk through it. So here we go. I'm going to share my screen. Make sure I got everything up for you. And what I went ahead and did, just so you understand the process, and I'm going to walk you through it, is I went in and I found a property in Cincinnati, Ohio. I went right on Crexy.com. Okay. Right on Crexy.com, searched in Cincinnati, Ohio for multifamily properties between 10 and 30 units, went through a few and found a couple that I liked. I don't know if it's going to make any sense, but we're going to go ahead and run through it. But that's going to start the process. Now, keep in mind, and when we get into this, finding the deals, okay, starts with the on to get to the off. Right? You start with the on to get to the off. You start with the on to get to the off. I know I'm in small screens. You can't see me as much because I'm sharing it. But you start with the on to get to the off. So this is an on-market property on the website. I'm going to leverage this property. If it doesn't make sense, doesn't matter. I'm going to leverage it to get access to this broker's pre-market deals. Okay? So let's go ahead and kind of show you what this is. So every single time you go on, and I'm going to go to the website itself first and show you that. That way you can see the actual property itself. So I went on to Crexy.com. Once I searched Cincinnati, Ohio, came up with a few properties. This was one I identified. It's on the market right now. Been on the market 15 days. It's a 17-unit property. They're asking $2 million. I think that's about $120,000 a unit, if I'm not mistaken. And it's renovated. You know, guys have bought it. They've renovated it. They've probably owned it for several years, and now they're selling it. It's our job to kind of go in and see, does this thing make sense or not? Yes or no? So Kennedy Heights investment opportunity, 17 units, asking $2 million for 17 units. I'm going to go ahead and come in here and I'm going to click on the OM, view the OM. That's an operating memorandum, offering memorandum. So that is basically a broker's pitch deck, right? A broker's flyer of the property, breaking it down, what it is, what the property is, some of their projected financials and actual financials. And your job is to kind of go through those and then analyze that. Okay. So that's the first step. You're going to come in here. This is kind of interesting. This is cool. Look at some of the photos. That's cute. And look at the area, all that stuff, which is nice. One of the first things they actually done a fair job on the reno. They've got shaker cabinets, little granite slab countertops, little backsplash, subway tile. They've done stainless steel appliance package in there. Very basic stuff. So a unit like this, I guarantee they renoed this unit. They did the bathroom. Okay. Yeah, so depending if they didn't do washer dryer connections in there and stuff, they were probably about $10,000 a unit on those units when they did it, realistically. Maybe a little more, a little different, but right in that pocket. You know, from that 10 to 12,000 bucks a unit when they renovated these things. Be willing to bet you. So it's very similar to a property that we bought years ago in Kansas City. So, okay. So that is the property. Now I'm going to show you the OM. So that way you can understand that, okay? So I've already downloaded it, and here we go. So all this is a PDF download you're going to get. Sometimes it's just a flyer on the property. And you're going to be going through it, taking a look at it, what the property information is. It's telling you price that they're offering it at. Sometimes they don't even have a price, right? You come up with a price based on your analyzation of the financials. 17 units, giving you some building size, renovation dates, zoning, blah, blah, blah. A little bit of the area, some of the utility information, property details, et cetera, et cetera, et cetera. So this is nice. So you kind of see some of the aerial information here. So you understand what my mind's going to see when I would see this. Immediately, I'm going, okay, street. I see that there's single family mixed in with multifamily buildings along that street. I like that. You're not in an industrial commercial zone. So just from a safety and pride of ownership and location mentality, it looks like a fair location. I mean, I don't know the area that well, but based on what I'm looking at right now, it's a fair location. You know, decent little neighborhood. It's mixed in here, and I'm looking at some of these aerials. You got some single families mixed in there with the multifamilies, and I like that. So it's mixed zoning, and I don't see a lot of commercial and industrial right around that. I don't see any liquor stores or 7-Elevens or smoke shops or any of that stuff right next to it. So you want to make sure of that. And the other thing you're going to do is if I was driving down the streets, I'm counting the bars on the windows on either side. You're going to do this the first time you're driving down. You're literally going to drive the blocks, and you're going to count the bars versus no bars on the windows, right? And if there's more bars than not, you're not buying there. It's just the way it's going, right? You're not going to buy into an area where you need a gun to go collect the rent. I'm sorry. It's just not going to be a smart investment for you, short or long term. So you need to make sure that the area is moving in the proper direction and it has safety so you can draw in good tenants and the things you're trying to do to invest in it. So location is very, very, very important, okay? So these are the things I'm looking at when I'm going through it. They've done a fair job. They did some nice, little exterior paint, fixed up some railing. They did a nice clean reno job. Someone probably took something like this and they renovated it and turned it into that. So you could go literally buy the ones next door if you wanted to, depending on what they are. But I like that because you have a mixed little single family mixed in with a multifamily. Then you got a little multifamily. So I like that zoning and how they set it up. You can see how this property is set up as well. 3-story building, but 1 story, the first floor is quasi-subterranean, meaning it's about 3-4 feet of subterranean and then the rest is above ground. So pretty common in the Midwest. So you just want to check the waterproofing. I'm looking at things like here. They have downspouts, they have rain gutters, they have overhangs, newer windows. Everything seems to slope away from the building. So these are just the things that I'm looking at when I'm going around looking at the foundations, the stucco, the windows, the roof, drainage, all of that. Okay, it's basic stuff when you're looking at a property. Looks like a decent parking lot. It's got good parking. It's tucked in the back there, so that's nice. And then some interior photos. Looks like they still have the popcorn ceiling in there, so that may be an upgrade to scrape that. But overall, pretty fair little job. And give me some info on the area. So that's all this is doing. And then they come down here and they start giving you some financials. So they're going to give you a profit and loss statement on the building of current, and then they're going to give you a projection, right? Current, and then give you a projection. They're going to give you a rent roll. Sometimes, depending on how many units they are, they'll give you a summary of the rent roll. Sometimes the entire rent roll. In this case, they gave you all 17 units. They're giving you lease dates, square footages, bedroom baths, current rents, future rents, any additional fees and stuff they're generating from the property. So they're kind of giving you a snapshot of each of the units on it. So I like that. And then they should be giving you, oh, they actually did do that. Okay. So yeah, they gave you some basic summary of investment financials and stuff. So now we found the deal. Okay, step one. Whether it works or not, we're going to determine that. Now we're going to analyze it. So I'm going to take how you analyze a deal when you start is you're going to take this data that they're giving you, because this is the best possible scenario you can have. The broker is obviously fluffing it up. So they're going to present the best information ever to you in this pitch deck, right? In their offering memo on the property. So you're going to go ahead and take this data, plug it into a deal analyzer. I'm going to show you the one that we have, a very basic, simple one that we give to all of our mentees under 50 units. We have two different deal analyzers. One that's like from a 5 to 50 unit property. So it's simple, especially when you're getting started. You don't want to like look at 14 snapshots of tabs and it's going to blow your mind. So simple one to start. Once you get good at that, move you into the more detailed one. So I'm going to show you the basic one this evening. And we're going to walk through that right now. How's everybody doing? Let's take a little temperature check. Little thumbs up. Is this making sense so far? Yes, no, maybe so. Awesome. Okay. Beautiful. How's it out there in New Jersey and Florida, the East Coast? Because you guys are about 9:30, almost 9:30 out there. Great. Cool. All right, so let me share my deal analyzer. And I've already thrown some of the numbers in there for you. But what I want to do is go ahead and get through this analyzation, show you the numbers, then I'm going to open it up to a lot of Q&A. Because what I want to do a little bit more of this week that we didn't do last week is open up to a lot of Q&A so I can answer a lot of your questions live. I'll even bring you on screen. I'd like to do that quite a bit this evening and bring people on screen, okay? So let me go ahead and here we go. Can everybody see that Excel sheet? Okay, is it zoomed up enough? Okay, awesome. Perfect. So these are not the photos. Don't worry about those. I probably should have uploaded new photos. But these are the numbers. So I went ahead and I plugged in their pricing. So up here at the top, everything in blue, you plug in. Everything in black is hard-coded. Everything in blue, you plug in. Everything in black is hard-coded. So price, I put in $2,050,000. For simple math, right now, I'm going to presume 35% down. Maybe it's 30, 35. It's going to be right in there, okay? And 17 units. The price per unit's hard-coded. I'm going to add in $50,000 in additional reno stuff that I may do to the property, may not do to the property, but for now, I'm going to plug it in there. Building age, 1971. That's on that document that I was showing you. Lot size is on that document. I plugged that in here. I'm going to put in here a closing cost of 6%. Why am I putting such a higher closing cost in there? Because about 2 to 3% of that is an acquisition fee that you get for putting these types of deals together. It's very standard. So that way, if you come in with $20,000, $30,000, $40,000 of your own money on a deal like this, you're getting 2%. That's $40,000 coming back out. 40,000 goes in, 40,000 comes out. So you may even get into this thing with zero, technically, right? It's Peter to pay Paul. And I'll show you how that works if you have questions on that as we go down. Interest rate. Right now, today's interest rates for a loan amount of, say, $1.3 million, if you're looking at these numbers right here, that's a 65% loan to value. $1.3 million loan. In today's market, it's a stabilized property, meaning it's cash flowing from Freddie or Fannie Mae. Any of the lenders that are in our system with our mentees and everybody, they have access to all these loans through our financing partners, somewhere in that 6 to 6.5% range, right in that pocket right now for this type of property, 17 units, Midwest, $1.3 million. That's your interest rate, fixed. Okay, so I have that in there. Now this is a 1-bedroom, 1-bath property, 17 units, all 1-bedroom, 1-bath, so 1 unit type. They're getting $950 a month for those units currently on the rent roll. That was on the data that they gave me on that OM. 650 square feet. So I'm plugging all that stuff in right here. 650 square feet. And the projected rents, right? Projected market rents are a little bit higher. Another $45, so $995. So that's the future projected rents. $950 now, $995 later. So I'm going to plug those in there, okay? Now you come over to the expenses. and we have to plug in some expenses on the property. All of this data is available on that OM that I was showing you a few minutes ago. It's all there. So all I'm doing is plugging it in so that way I can start to look at the math and see, once again, can I fit into this? Can I fit into this box? Because if I can't fit into this box, we're just going to keep moving, or we're going to start adjusting things to make sure it does fit in that box. Okay. So taxes, insurance, maintenance, repairs, turnover. Turnover is when you have to get the unit ready for a new tenant. Tenant moves out, new tenant moves in. Okay. Utilities, general administrative, contract services, marketing, a little bit. Probably don't need a lot for a small property like this. A lot of it's just going to be syndicated through any of the property management softwares. So a lot of your marketing expense is in that management fee down there. Okay, is in the management fee. So management fee is here, reserves and replacements. That's for any capital improvements that you may have to do to the property throughout the year that you're not planning for. It's not typical maintenance and repairs. Just to give you a perfect example, I got a call yesterday. One of our condenser units in our building in Kansas City blew up. So they're having to go out there and set a new one on the roof and do all this stuff. That's a reserve, right? Because you don't typically have that in your day-to-day budgets. That's a capital reserve item. So that's going to be in here as well. And that's all there. So realistically, and that's why I pay attention to these numbers here. Okay, where it says expense ratio. What that is the percentage of the total expenses, right? These numbers here, to your effective gross income, which is this number here. So here, I don't know if you can see where it's boxing it on the screen there. It's taking my total expense number divided by that EGI, operating income number of 185,000. So 61,000 divided by 185,000 gives me that 33%. Realistically, for a building like this, it should operate about 10% higher than that. Of this age, this caliber, they've renovated it, but still, that's why I want to, once again, I want to look into these two numbers, the property taxes and the insurance for Cincinnati, Ohio. Does anybody, maybe you're here and you know this, does anybody know how property taxes are calculated in Cincinnati by chance? Anyone? The answer is no. That's totally cool. I wouldn't expect it. You can Google that. You can find it very easily going to the assessor's records website for the county, right? Cincinnati, Ohio, you go into the county website, they'll tell you how they calculate property taxes. I'd want to double check the insurance and the property tax numbers, because those are really key numbers, and they're usually big line items in your expenses, as you can see. They're typically big numbers, okay? But in either case, let's go ahead and take it for what it's worth. I'm using the numbers that I got from that offering memo from the broker and plugging in the numbers. So here we go. So now we plugged in the revenue numbers. We plugged in the expense numbers. All this is here, ready to go. So we're going to keep scrolling down, and we're going to get to where we're breaking this thing down from current, right? Current numbers and projected future numbers. So in this case, it's showing us current gross income is $193,000, almost 194. Then you're going to be taking out what we call economic loss, vacancy, credit loss, other thing. It's called economic loss. You have physical vacancy, but then you also have things like maybe somebody doesn't pay rent. That's called bad debt. Then you have things all called concessions. Maybe you had to give somebody a credit to move in. And then you have this thing called loss to lease. This is a perfect example. You have loss to lease. If they're getting $950, but the market rent's $995, well, you have a $45 loss to lease. Okay. So that has to be accounted for, because your gross potential income is much higher than that. So that's a loss to lease. But this all gets broken down into this total number here. That way we keep it simple. So 8%, it'd be fair. It probably is higher than that. It's probably 10%. But for the sake of this, we'll keep it at 8. The other, like the broker had it at like 5. Once again, brokers are fluffing the deal. So that's just not realistic. So I'm going to keep it at 8, and we'll see where it goes. I plugged in their other income numbers. So other income is a great way to boost the net operating income on your properties. This could come from parking, pet rent, laundry income, late fees, administration fees, like on and on and on. There's like a literally litany list of other income items that you can have on your properties. I mean, on one of our deals, we have like 35 other income items, everything. It's a litany list, okay? So you can have valet trash. I mean, you have all kinds of things, cable income packages, all kinds of things you can create to boost your net operating income through the other income. So that's a great way to do it. If your rents are X, you can boost it through some other income items. There's ways to do that and get creative to boost the income on your properties, okay? So these numbers are already on the offering memo by the broker, so I plug those in. So now you get to this number called effective gross income, operating income, because now we've taken into consideration gross potential, we've taken out any losses, vacancy, etc. Then we've added in other income to get to this EGI number. Now we take out the expenses. And that's here. All that's happening is the number's coming from up here. Comes from here down here. So that's all that's happening. So we're taking that out, and then you get to this beautiful number that many of you have heard a little bit about, net operating income. And that is essentially your free cash flow before you pay your loan on the property. Before you pay the loan on the property. I was gonna put up a poll Q&A as to who knows what net operating income is. Is it A or B? I should have done that before I gave you the answer. So, but net operating income is basically the free cash flow before you pay your loan on the property. Okay, before you pay the loan on the property. Okay. And let me just double check this number real quick. Okay. So, based on this info, with 35% down, see if we did 30%, this would probably change this math. Yeah, it does. So I'm going to kind of show you that for a minute, because there's different ways you can make deals work. So they're asking $2,050,000. A key thing to watch is this. I'm going to highlight this for you, because we're going to talk about it for a minute. DCR. Does anybody know what DCR stands for? Type it in the chat. Debt to cash ratio. Anybody else? Debt coverage ratio. Very possible. Oh, that's Stephen Parker. He's one of our mentees. He knows his stuff. Debt service coverage ratio, very close. So yes, it does stand for a debt coverage ratio. What that means and why this number is so important is because this is the difference between financing a residential property and financing a commercial building, which is what this is. Anything over 5 units is a commercial loan. Anything under 5 units is a residential loan. If it's a commercial loan, okay, if it's a commercial loan, the bank, okay, uses a debt coverage ratio to determine whether or not to give you the loan. So it's not really about you, and it's not about your financials, which is why it's easier to get a loan for a 17-unit building. This building right now would be easier to get a loan for than you going and trying to get a $300,000 home loan. The difference in why that is because the bank is going to underwrite the property. They're underwriting the property. They're not underwriting you. Okay? Property. If the property's financials produce a debt coverage ratio, typically between 1.15 and 1.25, they'll give you the loan. Because basically what that says is that there is enough net operating income. If you look at the net operating income of $124,000 and the debt coverage, the debt service is $106,000. Okay? That equals 1.17 times the debt service. So the bank can get paid by the property. The property's literally paying them their debt service. You don't pay it. So that is why The bank looks at the property. They don't look at you, and they want this debt coverage ratio right in here, 1.15 to 1.25. Now, right now in this market today, they want to see 1.25 or more. So as it stands right now, this property doesn't work. Okay. However, we can tweak some things, but on its surface, it doesn't work. Okay. Now we're going to mess around with some things. The other things I want you to kind of show you here is these numbers here. So let's start scrolling down a little bit farther. I'm looking at my cash on cash, right? My average cash on cash at 5%. Okay. That doesn't meet, and that doesn't meet. Now I could run some conditional formatting on that, make it a little nicer, but for now, let's look at this. So I want to try and get here. I want to try and get here, and I want to try and get here on those three numbers. We're going to try and see where we can actually make it work. So there's only a few levers you can pull. So let's presume that they're not going to move on the purchase price. They want their $2,050,000. Okay. So there's a few things that can work. Either interest rates miraculously go down, which is likely going to happen here not too soon. So let's say hypothetically the interest rate went from 6.25 to 5.75. Let's just play with that number for a minute. It goes from 6.25 to 5.75. So what that's going to do is drop my debt coverage or my debt service. Okay. Now it doesn't move up too much, but it does move my cash on cash up and my IRR up a little bit. Doesn't really move my equity multiple. It does make my debt coverage ratio do what? I'm fitting into that now. I'm real close, simply by adjusting that interest rate a little bit. But that's still not enough. I wouldn't do the deal. So we need to start messing with some other stuff. So let's move the interest rate back, 6.25. And let's go ahead and put 35% down. Let's put more money down. Because if I put more money down, cash, that means less debt, which means my what? My debt coverage ratio is going to be better. Oh, look at that. Now we're in the game. So the bank will give us a loan. Bank's going to give us a loan. But that doesn't mean we're going to do the deal. Because look, now what happened? My cash on cash went down and my IRR went down. Why? Because I had to put more money in the deal. So because there's more cash in the deal, I'm not getting as much return on my money anymore. So what? Those returns went down. Well, that isn't going to work. So now we need to adjust some more things. What if the revenue goes up? What if we put 30% down? So we keep it at 30%. And let's say that we find out we can get the rents up to $1,050 a month. Right? They can go from $950 to $1,050. We can raise them $100. What does that do? Oh, we're starting to play ball a little bit. So now we're into the sixes on our cash on cash. So check. Equity multiple. Woo! Check. And our IRR, we're getting real close. We're teetering out in this area. Right in there. We're real close. Now, if you were doing this deal solely yourself, you may take that. That could be a fair enough return for you personally. But if you have investors involved, if you want to attract money into the deal, so that way you're only having to come out of pocket with $20,000, $30,000, $40,000, well, then you need to attract money. That's why you need to look for these types of returns. So 14 to 20%, we're not there yet. Well, it doesn't look like let's say rents can't go up. Interest rates aren't going down. It is what it is. We can only put 30% down. That's all we can do. Okay. So that is what it is. Interest rates are what they are. So there's only one other lever that gets pulled. Price of the property. That's the last lever. So it's not worth what you can do to it. It's just not. So let's say this thing drops to $1,850,000. So we can't pay $2,050,000. We're going to drop this baby $200,000. What does that do? Now we're starting to play ball. Now, what's in line? So we haven't changed anything else. Everything else is completely identical. All we did was adjust price. Now our debt coverage ratio is in line. Okay? Cash on cash in line. Equity multiple in line. IRR in line. We're writing an offer. So now we're going to write the offer at $1,750,000. $1,800,000, $1,750,000, $1,800,000. But you're going to call the broker. So this is how at this point I would go down with this. So now we've established that everything else being equal, we can buy the property for $1,850,000. But we're not going to start there. That's bad negotiations. So we're going to start at about $1,750,000, $1,800,000, somewhere in there. But you're going to have a call with the broker. You're going to call Mr. Broker up here. So let me share this. Come back to the property. And let me share that. Okay. So back to the property. So I'm going to come down here to Mr. Adam Curry from KW Commercial and ring, ring, ring. Hey, Adam, how you doing? It's Justin Brennan with the Brennan Poley Group, calling on your property there. We're on Kennedy Heights, a 17 unit. Looks pretty cool. Yeah, it is. Great. Great. Awesome. Hey, I was taking a look at it. I'm going to be in town in a couple of weeks. I'd love to tour that property and take a look at it. Are you doing tours as a group or are you doing them individually? Okay, you're doing them individually. Perfect. Great. Can I go ahead and schedule that up? It's going to be on August 7th, and I'll be in town over the weekend. Maybe I can see you on a Monday and we can come by and take a look at the property and get some information. And they may ask you a couple of questions on who are you? What do you do? Have you done this before? Some basic stuff. That's all fine. You can kind of work through that and get to the point of you're just scheduling a tour. Okay. Keep in mind, whether the deal works or not is irrelevant. What you're doing is you're going to do this to this property and you're going to do this to 2 other properties. So that way you have 3 tours. It's all going to happen in 48 hours. And I'm going to go meet Mr. Adam. Maybe they're doing individual or group. I'm going to meet 2 others, individual or group. I'm going to tour 3 properties. I'm also going to meet with a couple property management crews in the area while I'm there. And those, I'm going to say, hey, Adam, by the way, is there a couple property management companies I can talk to in Cincinnati right now that you could recommend? Great. Get their information. Talk to the other broker. Great. Get their information. Great. Brokers are going to be your gateways, right? And they'll share that information. No problem. Hey, Adam, is there any local? I know I saw in your offering memo, you had loan terms in there because they did. They had some loan terms in there. You have a couple local lenders that you could recommend. I may not use them. It's not the point. What I'm trying to do is build rapport and get information on the marketplace. Because now I'm going to go in there. I'm going to meet with property management crews. From the property managers, I'm going to get a couple of renovation guys if I need renovation, construction, and all that stuff. And now I have the brokers. So now I'm making a relationship with the broker, property management crew, construction crew, and now I have a couple lenders local. And I did that within 48 hours in the market that I'm interested in. Now, I may walk this property, like it, not like it. Let's presume I do. I chat with Adam. I say, Adam, I've already analyzed this deal. And I know you're asking $2,050,000. Based on my analyzation, most we're going to be able to pay is about $1,800,000. I don't know if it's anything the seller would consider, but I'm going to write you a letter of intent, an LOI. And I'm going to send it over to you, and let's talk. And let's see if we can make it happen. If not, look, we're buyers here. We're going to buy in Cincinnati. We're going to buy here in Cincinnati. So if this deal doesn't work, I hope it does. But if it doesn't, do you have any other pre-market stuff you can kind of start sharing with me that I can kind of get my hands on, start looking at in case this one doesn't work, right? If you don't have that conversation, then you'll definitely have it if the deal doesn't make sense. Now you're going to lean in a little farther and say, hey, looks like this deal's not going to make sense, Adam, but I'm definitely buyers in the market with our team and us. Do you have any other deals we can look at? Get on your list of pre-market stuff that you may have that's coming to market soon. So now what you're doing is you're starting to build this process of on to the off, on to the off. And why that's so critical is because if you were to take, okay, if you were to take, I'm going to share this so you can understand. If you were to take these deals on the website, okay, this is Crexy.com, all these deals, whatever those are, let's say there's 50 of them, okay, this only equals 40% of the market, only 40% of the market. So if that's the case, then you have 75 that are not even on the website, but are available for sale that you're not seeing. Because these are the pre-market deals. Pre, on. You can call these off, call them whatever you want. Off, pre-market, on, right? These are the ones that make sense. These are the ones you want. These ones won't make sense 95% of the time. These ones will make sense 95% of the time. You need to get access to these, and you do that by leveraging the process I just talked to you about. That is how you'll find the deals. That's how we found 95% of our deals. Is we leverage the on market to get to the off market. And we do it through the broker relationships. And you will build those slowly and small and quickly within the market. If you move, you can do it. I just gave you a perfect example of exactly how I would do it in Cincinnati, Ohio. So, okay. Awesome. So I do want to open it up to Q&A. Is there anybody that would like to come on screen and say hi? You can just raise your hand, put a little thumbs up, and maybe even talk about a deal you're looking at, deal you're doing, things that are going on. Love to bring somebody up on screen. And if not, I'm just going to force feed you. You're going to have to come on. But I don't know. Is Steve Parker still here? Would you like to come on, Steve? Say hi. Sure. Beautiful. Let's do. I'm going to move you real quick. And hold on one second. Bringing you over here. Okay. Is it allowing you to talk?
It is, yes.
All right. Steve, how are you, man?
Great. Thanks. How are you, Justin?
Good. Happy Tuesday.
Exactly.
You'd sent over a deal to us, I think earlier over the weekend, if I'm not mistaken. And I know Reed responded back. Where's that deal at?
Right now, doing some due diligence on it. I have secured a soft commitment for a renovation loan in the amount of $1 million. Interest rate's a little bit of a killer, but
Is that like a 10 or 11%, I'm guessing?
it's 11%. Yes.
Yeah.
A 2-year term, which I've already talked to a couple of contractors in the Cleveland area. Renovation budgets range anywhere from 800 was the low to 950 on the high.
Yeah.
It's a complete renovation of a 28 unit, very, very, very nice area of Cleveland, the west side between Cleveland and Lakewood. So it's a brick building built in the 1920s.
Is this the initial one that you had shown me?
I believe so. Yes. Yeah.
Okay. Awesome.
Yeah. The seller was wanting $1.5 million for it originally. I've got him to agree on a sale price of $1 million, and he's willing to carry 75% of that at 6%.
There you go.
So it makes the deal work.
Yeah.
I do have equity partners in the deal. I'm going to be putting in about 120, and then they're going to put in about a little over 500 to make up the 25% down for the purchase, and then also the 25% down for the renovation loan as well.
Okay. So let's walk through this real quick, just for simple math. So you got it for $1 million.
Yep.
$1 million. Oh, didn't like me. There we go. And you're going to put $1 million into it?
Yes, about another $1 million into it. Yes.
Okay. That's your reno. What do you expect kind of your closing cost to be? Are you like 6%? Are you using 6% of that?
6%. Yeah, it's about 6%.
Okay. So 60 grand. So you're at 2,060,000.
Mm-hmm.
Give or take.
Correct.
$2 here or there. So if everybody's following me here, just so I can show you guys this. So he's buying it. Here's your price, purchase price, renovation. He's improving the property, putting $1 million into renovating it. Closing costs of $60,000. That's going to include a fee for Steve, as well as legal, title, escrow, closing costs. So all in at $2,060,000. So now it comes down to you have the seller carrying $750,000.
Yes.
So the seller's going to carry 75% of this purchase price. Purchase price is $1 million. He's going to carry 75% of that at a 6% interest rate. Is that what I understand?
Yes.
And then
Coordinate with the rental loan.
And then what's your rental loan?
The rental loan is about
$1 million.
Yeah. Mm-hmm.
And you got $1 million rental loan. And what that's 11% interest rate. Okay. So that's $1,750,000. So now you got about $310,000. Is that what I'm gathering?
Yes.
Does that sound about right?
Yeah, we're putting in a little bit more into the deal too as well. We're going to end up with probably about $500,000 into the deal.
Okay. So yeah, well, so let's do that. Just for simple math, we'll just say $500,000. I mean, $500,000 in. So now the question becomes, as everybody asks, well, I don't have 500,000. How do I bring in the 500,000? So what you're saying is you have equity partners that are bringing in how much?
They're going to bring in, it's an 80-20 deal.
So they're going to bring in 300 and something thousand.
Yes. Mm-hmm.
So let's just say 350.
So basically they're going to bring in 400 and I'm bringing in 100.
Okay. And so this is your investors, and this is you.
Yes.
So just so everybody watching understands the way you could do this, and how much are you giving up of the deal and how much are you keeping?
It's going to be a 70-30 on the on the back end.
So if you got, I mean, it's up to you. I mean, you could probably still keep the 70-30 split if you got a couple more investors to come in with a little more money, but I mean, depends on the situation, right? So, but if you have that ability to bring that in, great. So for everybody kind of watching, if you don't have that, typically, right? So you understand the 500,000 now. Typically, the way that it would work is 50,000 would come from you, and 450 would come from the investors.
Yeah, I wished it was that way.
And it's
but I could only get 400,000 out of them.
Yeah, and so it's like a 90-10 on the equity, on the money. Okay, 90% comes from the investor, 10% from you, and you get, okay, for that it's a 70-30 split, right? 30% to you, 70% to the investors. So think about this for a minute. For bringing in 10% of the money, you get 30% to 40% of the deal. That's typically how they get structured. On top of that, do you have an acquisition fee built into this at all? Like
I do, yes.
Okay.
Yeah.
So typically as well, on call it $1 million deal, there's going to be a $20,000 to $30,000 acquisition fee. So picture this for a minute. $50,000 literally is out of my pocket. I'm going to get an acquisition fee of $20,000 to $30,000, which is very standard for putting all this deal together and working hard to put it together. So 50,000 is going out, 20 to 30 is coming back in. So you can do the math, right? You're going to have somewhere between $20,000 to $30,000 out of pocket. And now you have access to own a 28-unit apartment deal in Cleveland, Ohio. Is that how I'm gathering it?
That is, yes.
Okay. So for everybody watching, when they say, oh, I need, you don't. It's just what you do need is you need to understand the value of OPM. You need to know what is the projected kind of returns, generally speaking, on an annual basis projected on a deal like this for the deal.
So it is, out of the 28 units, it is 18 2-bedrooms and 10 1-bedrooms.
Okay.
The 1-bedrooms should rent for a minimum of $950.
Have you gotten to like the percentage side of the deal yet, where I was going in the 14 to 20% range?
Yeah.
Okay.
So I could pull it up because I just ran the numbers again today after I got the commitment.
I'm just kind of curious, is it because it's a large reno deal? So
yeah,
you know, you're looking down the road.
Still, yeah, the obviously the DCR, when you run that, it was at a 2.6, I believe.
Right.
The IRR was a little over 17.
Okay. Yeah. So think about this.
Yeah, and the cash on cash, I want to say was around 8.
Okay. So, and that's for the property basis, but let's just call it 17% for simple math. And then that way I know we're running up on time, but if everybody can give us a few more minutes, we'll finish up here. But 17% return on people's money. So think about it. If I came to you as an investor and I said, hey, I have a 28 unit apartment deal in Cleveland, Ohio, and I show you the deal on a nice little deck, and I say the projected returns are around 17% a year on your money, minimum investment is $50,000 into it, you may think, gosh, that sounds very interesting. Can you send me some more information? So understanding the value of OPM, and that's for another, maybe we'll talk about that next week even more. But this is how deals like this get broken down, where you literally can go control, manage, and own a 28 unit apartment deal in Cleveland, Ohio for 20 to 30,000 out of pocket. 50,000 in, 20, 30 out. And now you're in control of something, and now your portfolio, and you just added millions of dollars in net worth. I mean, this is how this goes down. So if it's this kind of stuff you want to learn, we love it. That's what we're here for. So any questions on this in general, before we kind of, leave it to last Q&A and all that stuff? Yeah, Steve, thank you so much for coming on and talking about that.
Yeah, no worries. I had to tweak your form a little bit because I had 2 different loans that I had to carry here. So
yeah, that's a little bit. Yeah, you're right. That is a little bit different on that front. So
yeah.
So cool. Cool. I think did it. Oops. There we go. Awesome. Any other questions for anybody? As we're kind of coming towards the end here of our Tuesday night. If by chance anyone is interested in learning this stuff, what we are doing, and I'm going to put this in the chat. Click on that link. So what we're going to be doing for 3 people this week only, okay? For 3 people this week only. So we have a mentorship program. If you just want to learn more about it, just click on the link. We're no heavy sales, not doing any of that. But what we are doing for 3 people this week specifically for $700 a month for 12 months, right? You can do the math on that. You can come into the mentorship. Most people pay this up front and pay in full and pay in lump sums. For 3 people only, we're isolating it. You can do that and do it on a monthly basis for the next 12 months. So if you're interested in that, obviously raise your hand in the chat, click on the link. You can set up an appointment right through that link as well, and we can chat with you a little bit about that if it's something you're interested in, okay? But we want to offer that as an amazing opportunity because what we're building, like Steve just kind of discussed, is an incredible community of well-trained investors who are doing deals around the country, and we would love to be able to try and partner on deals that are going to make sense. Teach you how to do it, number one, but then find deals where we can grow and partner alongside people and investors around the country. So that is what it's all about. Any other questions before we kind of finish up? That's my plug for the night. But I hope that made sense. Yeah, that was great, Steve. Thanks for sharing that. And keep us in mind if that thing kind of, you need further help on that. Oh, thanks, Steve. I appreciate that. Yeah, that means a lot. Yeah, we work hard. I want people to get access to us and not some hired coaches, random people, and all that stuff. So that's why we do these things. And we're trying to provide enormous value, even on free nights like this, but help you out if you're trying to get into this space. But think about this. You can go buy apartment buildings for $20,000, $30,000, $40,000 out of pocket. This is no joke. And I can show you exactly how to do it. I mean, it's how we started and how we've grown our portfolio from literally one condo worth $100,000 to now over $157 million in assets and 500 plus units in 5 states around the country. I mean, this is how you do this. And we're growing towards 10,000 and $1 billion. But obviously, this is how you do it. You do it with partnerships. You do it with people. You do it with investors. Everybody's doing well. Everybody's growing. Everybody's making money. That's how you do it, right? You don't do it alone. So awesome. I appreciate everybody coming in. Yeah, click on the links. If you have further questions, information, just learn about it. Let's set up appointments. If any of you guys want to take advantage of this, it is for this week only. So you'll want to do it, or at least set up the appointment by Friday at the latest. At the latest, probably sooner, because for only 3 people, it's probably going to go pretty fast. So awesome. Thanks, everybody. Appreciate it. Have a good rest of your night and happy Taco Tuesday.